Today is Friday, January the 17th, and this is the third in a series of videos looking at Tesla and for an opportunity for the bulls, or people who are bullish on this stock, to get a piece of the action using calls instead of paying over $500 for one share. We're going to try to pay a lot less for some action on 100 shares, or an analog of 100 shares. So we know, first of all, that we're still down $4 today, so we're not ready to buy. So this video is going to take a look at the option chain. First of all, we want to look at when earnings are. Earnings are January the 28th. Do we want to buy Tesla before January the 28th unprotected, meaning just expose yourself purely to the stock by just buying calls, or you could buy a vertical, or you could buy a calendar spread, which we can talk about later, but we're just going to focus today on just buying calls. So do we want to be exposed to the earnings on January the 28th? The earnings per share forecast is 57. The analyst consensus is to hold on to the stock, but not necessarily to buy, but their SMART score has moved up from 2 to 3. Anyhow, let's just get right into looking at options and how they work. And this is an option chain for Tesla. We're going to look at the implied volatility. That's the range of movement that's expected in the price. The open interest means how many contracts are currently open, whether they're bought to calls or sold calls. So you could have somebody buying the 600 call, and that would be open interest. You could have somebody buying a 590 and selling a 600, and that still would be an open interest on the 600. So that would be 2 calls. Then the delta is the measure by which your option is going to move for every dollar that the stock moves. So if you have a delta of 50 and Tesla goes up $1, your option's going to increase by 50 cents. Now the next dollar, it's not going to increase 50 cents because the delta will have changed now because the price has changed, and then you bring in a factor called the gamma. And the gamma is going to tell you what the delta is going to be in the next dollar, the second dollar. But we're not going to talk about gamma today. We're going to talk about delta. We'll also talk about theta. So what is the time decay component? But first, let's look at implied volatility, and then we'll add in the theta component. So implied volatility next week is 50%. Let's just look at where we are today. So the in-the-money call would be 508, so let's just say 510. The volatility is 48.5%. So you are paying more for a call as the volatility increases. So if there was no volatility, you'd be paying less for the call. But there's a factor in here that's going to affect the price of the call based on its volatility. Let's look at just before earnings. The week of February the 2nd, what was that earning date again? It was January the 28th. So here is the week of earnings. And look at the volatility for that 510 call. It's 65%. And as we get closer to January 30th, that earnings on January the 28th, this volatility is going to go up. And it's not unusual to see 80, 90, 100% volatility in stocks like Tesla, or at one time Netflix and Apple, because people just didn't know, had no clue which way the earnings could go, because you really don't know what their expenses are, what their R&D expenses are, how much they spent on sales and general administration. So it's not just the number of cars that they've sold and the profitability, it's after all of the other expenses and other losses they might have incurred. So let's look further out into the future. On February the 7th now, the volatility for that 510 call is 69%, so it's even higher. So the market is making it more expensive for people to buy calls during the week of earnings as well as the week after earnings. If we go out to March, we see that it's come down to 55%. And if we go out to January of next year, we see the volatility for that 510 call has dropped to 45%. And if we go even further out to 2022, we can see that the volatility is 42%. So 42, 40%, 45% seems to be the uncertainty you can expect to pay for in your call options. Now we're going to change implied volatility to theta. Theta is time value. And let's look at time value for, let's not look at time value quite yet. Let's look at the delta. So delta tells you how much risk or what's your probability of being right. If you bought a 500 call, your probability of being in the money would be 65%. So even though your call is $500, you're paying $128.65 for it. Or actually you're paying $134 if you were to pay the ask price, but you're going to pay somewhere in between these two values. That means that the stock has to be at 500 plus 134. It has to be at 634 before you will make a nickel on January the 22nd. The idea with buying a call is to make the money as quickly as possible and not to let your call profit drag on as long as the expiration date. Not many options traders hold on to their calls until expiration. Typically they'll hold on to them for a much shorter period of time, particularly if they see a rapid acceleration in the price shortly after they've bought it. They're going to take that windfall profit and jump out. So I'm not necessarily looking for a 65% probability because I don't want to pay for that kind of probability. I'm going to look more like a 50% probability or maybe even less. So if I take the 620 calls, I'm going to pay $90 for that. So the price has to be $710, but I'm risking less. I'm only paying $90 instead of what we saw earlier, $134. So there's a trade-off. So delta is something to look at, and I would think that 50% is a good delta if you're willing to hold on to your play for 3 months. There's no way we want to hold on to it for 753. Oh, sorry, this is January 22nd. My apologies. Let's go to January the 21st, but it doesn't matter because very quickly the 500 has a 62% probability, and that would cost us about $600 before we made any money. If we went down to that 50% probability, it would be at 570, and our total move would have to be to 640 before we made any money. So I'm much happier than that with that than thinking about the 2022s. I just don't want to hold on that long. I want to wait until the stock has hit what I think is the bottom and is going to make a quick turnaround when it's oversold and people start buying it again, and I'm going to start making a good percentage on my investment. If I buy one contract of the 570s, I'm going to spend $7,200, $7,180 times 100, because a contract contains the right to buy 100 shares of the stock at the strike price, $570. So I'm only going to risk $7,125 if I were to buy one contract right now. Tomorrow, we're going to look at something different. We're going to take that strike, we're going to say, let's buy one. But then we're going to analyze it, and we're going to see how our investment is going to change with time and with delta. So what's going to happen to our $7,100? It's going down, isn't it? $7,090 now. It's going down all the time. That's why we don't want to buy it, because it's still going down. We're going to look at an analysis chart that's going to show us how our stock will respond for every dollar that Tesla goes up and down, and that's a risk-reward chart. And we're going to look at that on a time basis and a delta basis. But we've hit our 10 minutes for today.